So if you think about the name, that's half the battle. Real Estate Settlement Procedures Act deals with purchasing real estate. TILA, Truth in Lending Act, deals with borrowing money. So let me get a little more in depth in that, though. Let's start with TILA. TILA, as I said, is a Truth in Lending Act, not that celebrity that was only famous for like all of 5 minutes and then disappeared off the face of the earth. Y'all remember her? Tila Tequila? No? Yeah, Cheyenne just remembered. Oh, once you said the tequila, I got it. Yeah, Tila Tequila. She had like a love show, kind of like Flavor Flav did.
I was obsessed with that show.
There you go. Tila Tequila. Like I said, she had her 5 minutes in fame, and nobody's ever seen her since. So TILA is the Truth in Lending Act. Now, folks, some of these things have nicknames. TILA is also referred to as Regulation Z. Regulation Z. So if you ever see Regulation Z mentioned on the test, it's TILA, Truth in Lending Act. And so the whole purpose, as I told you, is so consumers understand the true cost of borrowing money. Any origination fees, any interest fees, how much you're going to pay over the life of the loan, all these different things. And so what the biggest piece of this is that lending institutions are not allowed to advertise loan terms partially. If they give you only parts of the loan terms, it's what we call a trigger term. It triggers the need for them to give you all the information so you can know what you're really looking at. Let me give you a prime example of the Truth in Lending Act in action. When you hear a car commercial in the car on the radio, and it says, "Drive a new Honda today with just $1 down." What happens at the end of that commercial? Yeah, there you go. Yeah, Tara's going this, and some of y'all are going like that. Yeah. Not all buyers will qualify, subject to credit approval. $1 down, 2.9% financing, like all these different details, right? That's TILA in action, because when they told you your down payment is just $1, that is a specific loan term, and they've got to paint a bigger picture for you. By the way, folks, buying a car for $1 down is not a good thing. Why? Because that means you're paying interest on the full car amount. It's a lot of interest. You do not want to buy, yes, sure, it's helpful if you need a car, but you're going to be paying a lot more over the life of the loan by doing that. So when you understand, financing and the way interest is charged, you make better decisions on this stuff. Yeah, there you go, Anthony. I hated explaining that as a dealer. Yeah, it's a big thing that people don't understand. Sure, it sounds great. $1 down sounds great. It's not really good. So the biggest thing is when they give you specific loan terms, it triggers the need for all the other information. Now, be very careful, because here's where students mess up on the test. If they give you costs that are not having to do with the loan, then it doesn't trigger the full disclosure. Meaning, by the way, folks, let me make this parallel and help you out. I told you that RESPA deals with borrowing money to buy a house, Real Estate Settlement Procedures Act. TILA deals with borrowing money in general. Can we all agree that if TILA deals with borrowing money in general, that it also applies to borrowing money to buy a house? It's a very redundant thing, isn't it? Because one deals with borrowing money to buy real estate, and one just deals with borrowing money. And so there's actually some overlap there, and you're going to see what happens with that overlap in just a second. And so if we were talking about seller paid closing costs, like $2,000, that's not a trigger term, because that's just the seller is willing to pay you some closing costs. If we said your HOA dues are $50 a month, that's just a cost, right? That's not a loan cost. So it has to be a specific number that deals with the loan. And if that's present, then it triggers the need for additional information. So we need to know the APR of the loan, all finance charges, total number and amount of all payments, and the total amount financed. These are the things that they're supposed to disclose to you. Now, not that you really need to understand this really for this class, but do know that APR stands for annual percentage rate. That is not the same thing as your interest rate. Annual percentage rate is not a trigger term because it's actually a fully encompassed ratio. It's actually talking about what your rate is as a percentage of all origination fees and cost for funding the loan. You can Google it, but you don't really need to know. It's just a technicality. APR is not a trigger term because it actually includes all the metrics. Just be aware of that. So let me give you some examples here, and you tell me, based on what I just explained to you, if you think that these things are trigger terms or not. Now listen to me before I show these to you. It would have to be a specific number dealing with loan terms. And if it's not that, then it's probably not a trigger term. So for example, if I said low down payment, do you think that's a trigger term? Yeah, that one is not, because it is not a specific number. It is a vague generalization. Low is subjective, so no trigger term. How about only $2,000 down? There you go. Specific number dealing with down payment. That is a loan term. That would trigger the need for the additional disclosures. How about low monthly payments? And again, vague generalization, not a specific number, not a trigger term. How about monthly payments of only $1,000 a month? There you go. Yet again, specific number dealing with loan terms. What you got, Ashley?
So I know you said like if it mentions like a specific like dollar amount, it would be a trigger, but is it also a trigger? Because I noticed that the ones that are a trigger have the word only, so it's like only $1 down, only 2,000. Like, does that?
No, only is more of an advertising word to make it sound good because it sounds like it's less than it could be. But even if it just said $2,000 down, it's still a trigger term. That only word is not going to change anything.
Okay.
Yeah, it's a specific number. Now, I did caution you though, specific numbers that don't have to deal with a loan, don't let that trip you up on the test. If I said $50 a month HOA dues, that is not a loan term. If I said seller paid closing costs, that's not a loan term. So you got to be very careful. Now, at the end of the day, we have to have a general understanding of this in the real world, but really and truthfully, lenders are the ones that are subject to this more than anything. We just have to have a basic understanding, but it is testable for you folks in real estate education land. But afterwards, it's really the lender's responsibility to make sure that the advertisements are in compliance. And the way that we as real estate agents avoid getting in trouble is never putting that information out on an advertisement unless it's given to us by a lender who is assured that it's in compliance with TILA. Now, here's the funny thing, folks. And this is where I told you, all RESPA transactions are automatically TILA transactions. That's how you know that nobody was enforcing either of these laws for so long. They didn't realize that until 2011, a year after the CFPB had been created. And I'll tell you what happens. TILA required an early truth in lending disclosure statement, and it required a final truth in lending disclosure statement to be in compliance with TILA disclosures. RESPA required the good faith estimate and the HUD-1 settlement statement to be in compliance with RESPA disclosures. Once the CFPB started enforcing these, they looked at them and they said, these do the same freaking thing. Why do we have 4 forms that are doubled up? And so what they did is they simplified it, and you're going to love this. They simplified it, and they created standardized disclosures that met the needs of both RESPA and TILA. And so every RESPA transaction is actually what we call you ready for this? A TRID transaction. TRID is very inception-y. It stands for the TILA RESPA Integrated Disclosure. So it's an acronym inside an acronym to create a new acronym. Or 2 acronyms inside an acronym. You see what I'm saying? It's horrible, but it is what it is. Now I'm going to get to TRID more in a second, but let me tell you the biggest things you need to know about RESPA, which is automatically a TRID transaction. This only applies to residential, okay? RESPA does not care about purchasing commercial properties. So there is no disclosure requirements necessary for commercial purchases. It is also not applying for cash purchases. It is residential purchases, meaning 1 to 4 units, where you are borrowing money from a federally backed depository. If that is met, then it has to follow all of the disclosure laws of RESPA, the Real Estate Settlement Procedures Act. So some of the things that are required under RESPA that are testable is that the lender would have to provide you what's called the shopping for your home loan book or toolkit. It can be tested either way. That first or second bullet point, I guess technically it is, the shopping for your home loan booklet or toolkit. They have to provide that to you. It's just a little pamphlet on understanding how shopping for a home loan works. The other things that RESPA states is that any fees that the lender is in control of, that they set, cannot fluctuate up. They could arguably go down, but they cannot go up. So their origination fees, when they give you what's called the loan estimate that says, here's what we're going to charge you, they're not allowed to raise it after they give you that loan estimate because they're in control of those numbers. Of course, other things that it does, folks, do you remember when we talked about the pity payment and I said, the bank's going to tell you at closing, give us like $1,000 to open your escrow account. Well, RESPA actually sets limits to how much the banks can take from you at closing. They cannot hold more than a certain amount of money on behalf of you in that escrow account. So RESPA would limit that. The other big thing that RESPA does, we've talked about. You may not remember it, but we talked about. Back in the agency section, I told you that there was some big laws that you wouldn't fully understand until we got later. And I told you when we were dealing with kickbacks, rebates, incentives, bonuses, extra commissions, anything like that, the way the North Carolina laws are written is that we as licensees can accept bonuses, rebates, kickbacks, commissions, so long as we disclose them in writing to our client prior to them making or presenting an offer, right? So in writing first. And so long as they do not violate RESPA. That's when I introduced the term RESPA. You didn't fully understand it. But now you can appreciate that it would not be allowable for other settlement service providers to give or receive kickbacks from each other. Meaning attorneys, lenders, brokers, title insurance companies, surveyors, appraisers, we could not give or receive kickbacks from these settlement service providers. The only exception to that is broker to broker referrals are always allowed. So I could give a referral fee to a buyer's agent as a seller's agent and vice versa. That's always allowed. But the other settlement service providers could not give or receive money to each other. That'd be a violation of RESPA. I'm going to pause for a second because I know I've said a lot in the past few minutes. I'm just going to let you take it all in for a minute. I know, Anthony. Oh, look, I can get close to my camera too. It's just kind of further away from me than it needs to be, though. So I can only get so close. Plus, nobody needs to. I feel like the camera is not as flattering when you're up right on it, So I'm gonna sit back here. That's what I'm gonna do. What you got, Beverly?
So the kickbacks are prohibited from service providers to other agents. But when we had this section on like property management, that is, those kickbacks are, or referral fees are allowable.
Yeah, you tell me why.
Huh?
Tell me why.
Because that doesn't, because those fees don't influence a loan. I don't know what.
Well, inherently, what does this word mean?
Settlement. Yeah, it's that closing.
Mm-hmm. There is no closing when you're renting. There's no settlement meeting. You're not transferring title. There's no, anything like that. It's temporary possession. So there's no settlement. So that would not kick in. RESPA only applies to borrowing money to buy a primary residence. They do not limit, rentals. That's not, it's not settlement.
Okay.
Yeah.
Thanks.
Yeah. And so that was the prime example because that's exactly what we said. If you were a property manager and you had somebody who came and cleaned the units and after every 10 units, they cut you a, $600 check as a kickback, as long as you disclosed it in writing to your property owner and they were cool with you taking it, you could take it. Not a violation. So it's disclosed in writing, doesn't violate RESPA, you're good to go. How's everybody else feeling? Because I know, like I said, this is gross. I know this is gross. Brooks agrees. I know.
question.
Yeah.
The 4 chief disclosures, was there one that wasn't on the bullet point?
Was there one that was what?
Was it a bullet point?
Yes, there was 2 combined.
Oh, okay. They're all
APR. Well, actually, there's all finance charges, total number of payments, the amount of payments, and total amount financed. Technically, the APR, as I said, is all encompassing. So all finance charges, number of payments, amount of payments, total amount financed. So let me introduce TRID, because I told you every single RESPA transaction was automatically a TILA transaction, because RESPA dealt with borrowing money to buy primary residence. TILA deals with borrowing money in general. And so I told you there was this redundancy. And so now you could call it RESPA, but it's really just TRID. It's going to be tested as both, though. TRID is the 2 acronyms inside an acronym, the TILA RESPA Integrated Disclosure. They basically dumbed it down, and so now there is an early disclosure that satisfies both TILA and RESPA for these TRID transactions, and a secondary disclosure that satisfies both for these transactions. And so the early disclosure is just called the loan estimate. So you do need to know that when you apply for purchasing a home subject to RESPA, aka TRID, they have to give you a loan estimate within 3 business days of loan application. And it is an estimate of all costs that you would potentially incur with purchasing a property. And that's where we said, I'm going to never stop coughing. That's where we said that the fees set by the bank are not allowed to go up. And then the rest of them are just an estimate, so they can fluctuate. Let me show you what this looks like, folks, because you've got a copy of a loan estimate in your online program. There you go. If you look in the financing section, here is a copy of a loan estimate so you can see what this looks like. So when you apply for a home loan and it falls under these criteria, you would have to be given this within 3 business days. And it's going to talk about what your potential loan amount is going to be, your interest rate, your principal and interest payment. It's going to talk about whether there is or is not a prepayment penalty present, whether you're going to have a balloon payment. We just talked about these terms. We're also going to talk about what your PITI payment is going to look like for years 1 through 7 and 8 through 30. Now, what's happening here, folks, this is going to be one where you are not putting down a 20% down payment. And so you're going to have mortgage insurance. But after year 7, they're assuming that you will be at over 20% equity. And so on year 8, your mortgage insurance falls off. Once again, principal and interest hasn't changed, but your T&I has changed because of the way that they're speculatively assuming that you'd have equity. Talks about your estimated closing costs, meaning what you would need to bring to closing. There's your cash to close. That's how much you would need for closing costs. Closing costs would include things like attorney fees, title searches, title insurance, initial escrows, a lot of different things. When we say cash to close, that includes your closing cost plus part of your down payment that you haven't deposited already or paid in advance. So this is the loan estimate, right? Just true cost of what it would look like to buy this home. Now, let me provide another piece of clarity here. Lisette says, would this have to be given to you before you make an offer? Here's the thing. You would want to apply for a loan and be pre-approved for a loan and have this in hand before you make an offer. Arguably, legally speaking, you could submit an offer before you have this, but it'd be very stupid to do it because you don't know if you're going to get approved or not until you apply for a lender. And most sellers would not be willing to accept your offer without a pre-approval. But there is no legal requirement to have this before you submit an offer. It just would be ill-advised. Okay, hang tight on that, Beverly. Let me finish this thought. Let me explain another very big testable thing, folks. Okay? And this is where I've told you time and time again, do not Google concepts in this class. Because if you see right here, it says the loan estimate has to be given to you within 3 business days. If you were to Google business days versus banking days, most resources would tell you they're the exact same. Monday through Friday. However, for the sake of the TRID rule, Saturdays count as a business day. Saturdays count as a business day. It's something you got to know. Banking days and business days, for all intents and purposes, typically mean Monday through Friday. So when we say banking days on the test, it's Monday through Friday. But when we say business days on the test, we mean Monday through Saturday because it's really only going to fall into TRID rule more than anything. And Saturdays are included. It's a crazy thing. Let me tell you why this last note's important, then I'll let you ask your question, Beverly. If you apply for the loan and you are going to be denied, they have to give you your denial in writing. They will mail you a copy of it. And the reason they have to give you the denial in writing is not purely because of RESPA or TRID. It's also because of ECOA. I'm going to teach you this later. ECOA stands for the Equal Credit Opportunity Act. And basically, it deals with discrimination in lending. There are certain protected classes, and so they have to tell you why you were denied so they can verify that it had nothing to do with discriminatory practices. But I will reinforce that topic later. What you got, Beverly?
So, did the curriculum... Okay, have I just had Slack agents? Because I don't remember just going into any detail about all of the mortgage stuff. That was all, you know what I mean? Like,
That's not really our job. That's lenders.
yeah. So I'm just kind of curious, like when I was licensed in South Carolina, this was a long, I don't know, it's like 2008. We didn't have to learn like any of this stuff. Did the curriculum change that now agents need to know more about the financial aspect? Or is this a North Carolina thing? You always had to know?
I mean, financing is a national topic, really and truthfully, but the curriculum is different in every state, and what they expect you to know is different in every state. And understand, too, that the whole purpose of this is not so you're an expert on any of it. It's so you have a basic understanding of all of it, just because you've got to be well-versed to understand the industry as a whole. And to be honest, Beverly, I would probably say that more than anything, they just want to make sure that your brain worketh, right? I mean, because they don't want any old idiot to have a license to sell real estate, because you got to have some mental processing power to be able to negotiate transactions and help people make good decisions and handle high-stress situations. So, more often than not, I would say that the curriculum is probably so hard to weed out the idiots. Yeah. Or the lazy people.
I don't remember. I'm like, did I ever go over any of this stuff with my agent? It was always like,
no.
Talk to your lender.
Yep.
Like,
and that's what you'll do in the real world too, even though I'm teaching it. You just got to have a rudimentary understanding of this. Yeah. Okay. Yep. So in the beginning, right, you apply for this loan. They have to give you this loan estimate within 3 business days unless they're going to deny you, and then they have to send you that denial in writing. Now, there is another disclosure on the back end. They have to give you what's called the closing disclosure 3 business days prior to settlement. Yet again, Monday through Saturday. Folks, understand that these 2 forms correlate. The estimate is, here's what it'll probably look like. The closing disclosure is, here's what it actually looks like. The whole purpose is so that you as a consumer can make one final judgment on, do you want to sign your life on the dotted line saying that you're going to bind yourself to these terms for the next 30 years? That's the whole purpose of this. It's also to verify that none of the lender charges change that are not allowed to change, and to make sure that you are still comfortable. And so if I show you, and I'll pull this slide back up, but if I show you in the online program, the closing disclosure is in here too. And it looks pretty identical. It's just, here's the actual one. that you get. And so this is what it actually looks like. And it's got all the itemized costs of credits and debits. And so when we've been talking about credits and debits, these are all debits to the consumer, right? These are closing costs. So these are loan costs, buyer debits. These are buyer debits, seller debit. And so it would ultimately tell you your cash to close as the borrower and the cash due to the seller on this closing disclosure. Brad says you may get a closing disclosure 3 days before, but that doesn't mean it's correct. True statement. It is what they have thus far, but there are some minor adjustments. Now, there are certain things that would trigger the need for a new closing disclosure in a new 3-day period if it was off by, certain percentage yield, on certain things. But yeah, they do have to provide you one within 3 business days prior to settlement. And if they don't, you're not closing on time. That's the biggest takeaway. So if you get this 2 days before closing, you can't close on your anticipated closing date because you have to have 3 business days. Now, this last little note, they will verify that you received it. What happens is your lender will send this to you in an online portal, and they will have you sign acknowledging it. And so that means we've confirmed delivery. And so that 3 business days starts counting. If they were snail mailing it, it would have to be 6 days before it can close because it has to allow 3 days to get there. And then 3 days for you to review it. That's kind of the assumption if they snail mail it. But they don't do that in the real world. They will send it to you in a portal and they'll have you sign confirming you received it. And as I said, yet again, business days Monday through Saturday. It excludes Sundays and all federal holidays. Now, we're not going to get into it too much more in depth, but there is a little bit more to the TILA RESPA discussion. Bree says, is that at least or no more? At least. It can be earlier. It just has to be at least 3 days. There also is technically, folks, there is a waiver you can sign waiving your right to receive it. It's not common, and that waiver is probably not going to come up on the test, but you could potentially waive your right to receive this closing disclosure, and then you wouldn't have to have it, but not common. So we are going to talk about these items a little bit more in a later section, the closing a real estate transaction section. I'm not going to really rehash the stuff we've already talked about, but I'll introduce some of the other things because I know this is rough. So mere moments ago, I introduced another piece of legislation, another concept, just to add insult to injury, and that was ECOA. Who remembers what I said ECOA stood for just a moment ago? Anthony, you remember? What is it?
Equal Opportunity Act?
Who said that?
No. Huh?
Say it again?
Was it Equal Opportunity Act?
You're missing one word.
Equal Credit.
There you go. Bree helped you out. Equal Credit Opportunity Act. There you go. Nailed it. Equal Credit Opportunity Act, ECOA. Folks, understand something, okay? And I'm going to give you this word of caution right now because this is another one of those things that is just cruel on the test. Okay, listen to me. The Equal Credit Opportunity Act deals with discrimination in lending. Yeah, Bree, don't yell at me. All caps. How rude. Yeah, I'm kidding. That's fine. The Equal Credit Opportunity Act deals with discrimination in lending. And so there are certain protected classes. But please do not confuse this with the Fair Housing Act, which also has its own protected classes and deals with discrimination and renting and buying real estate, right? There's a difference. This one deals with lending. The other one deals with where you live. And you've got to be very careful because I'll go ahead and kind of give you an insight here. These 5 are part of both ECOA and fair housing. These 3 are unique to ECOA only. As you can imagine, the dangers where they say which of the following is a protected class under ECOA or which is the following is a protected class under fair housing. If we ask you about fair housing and you say marital status, you're wrong. It's not protected under fair housing, but it is protected under ECOA. And so you've got to be able to differentiate the protected classes from one and how they differ from the other. Now, I'm not formally teaching you all of it yet because that's to come in a later section. But what I will do is show you a graphic that will help you to kind of differentiate it. And then I'll show the graphic again later. But that being said, I know I've tortured your brains quite a bit. Go take a break. So let me take this just a step further because, as I said, I'm not teaching you everything with protected classes right here, right now. But of course, we're talking about financing, and that's when the Equal Credit Opportunity Act comes into play. And so the Equal Credit Opportunity Act, I told you, deals with discrimination in lending. And these are the protected classes. And I told you those three in red are unique to ECOA, but are not part of fair housing. The ones in the black are part of both. And then there are two that are only unique to fair housing that are not part of ECOA. And so let me show you a graphic here to help you kind of see it all in one fell swoop. If you look right here, there was a buildup, if you will, of what is currently the fair housing laws as they stand. And so if you draw a line here, all of this is fair housing. So fair housing includes race, color, religion, national origin, sex, disability, and familial status. ECOA, race, color, religion, national origin, and sex are all part of both, right? ECOA and fair housing. But then I told you age, marital status, and public assistance income is unique to ECOA. And then disability and familial status is unique to fair housing. And I need you to understand something very important, folks, and this is going to be a very big thing to understand before we get into the fair housing discussions later. Not all discrimination is illegal. It's all not okay. It's gross. It's abhorrent, but it's not illegal. And so I want you to understand what this means for your test. If I said that a lender denied somebody because they had 6 kids, they did not violate ECOA because familial status is not protected under ECOA. If I said that somebody was denied a loan because they were disabled, ECOA was not violated because disability is not a protected class under ECOA. If I say that somebody was denied a house because of their age, that is not a violation of fair housing because age is not protected under fair housing. Do you see how confusing this can get on the test? It is only the classes that are present in the law. And if they're not present, they're not illegal to discriminate against. Now, we will get into this in a lot more detail later in the actual fair housing section, but I wanted you to see this graphic altogether, and I'll take a screenshot too, or if any of you want to do it right now, you can, but I'll take a screenshot too, and I'll put it, upload it into the GroupMe so you have this. I think this graphic is very useful to kind of see it. Now, the Civil Rights Act we'll talk about in the fair housing section, which is why I kind of didn't discuss it yet, because it's on its own little island, if you will, but very important to understand. Now, we're actually about to wrap up. You know, there's just a few things left, including the math, unfortunately, and then we'll wrap up the other financing section, which I'm sure you're happy to hear that before we move into bigger and I won't say better things. We talked about loan fraud a little bit already. There's a lot of different types of loan fraud. It could be falsifying documents to make it look like you make more money, lying about your place of employment. Of course, there are several other ones called contract kiting, which is where you would basically state that you're buying the house for more than you actually were and then negotiate with the seller that part of that was covering the down payment. There is, of course, also buying properties for, using owner occupancy loans like VA loans, FHA loans, and things of that nature with the intention of them being investment properties. But loan fraud is, of course, a very big thing. It's a felony, and it is punishable by fines up to $1 million and up to 30 years in jail time. Okay, and so it is not something to take lightly. I'll tell you one of the other most common types of loan fraud that exists in the real world, not just the textbook world, is falsified gift letters. Meaning your mom, your brother, your grandpa, your grandma, somebody is giving you a gift to help you buy your first house or something like that. Well, the thing is, gift means they don't expect it back. So if they lent you that money and you have them sign a gift letter and then you're actually paying it back like a loan, that's loan fraud. Because what the gift letter is stating to the bank is that they don't expect it back. But if they are, that's loan fraud. Does it happen all the time? Sure. But real gifts are fine, right? If they don't actually expect it back, there's nothing wrong with that. But of course, loan fraud is a very egregious thing. Now here's where the little bit of math in this section comes into play, folks. Earlier, we were talking about underwriting guidelines, and we were talking about debt to income ratios and credit scores and things of that nature. And so let me explain the debt to income ratios. If you make $400,000 a year, that's great. But if you have such a high amount of recurring debts that you really don't have any money left to spend, you're not getting a new loan either. And so they don't only look at what you make, it's a correlation between what you make and what your monthly debt is. That's why it's called a debt to income ratio. And so for conventional loans, there are two ratios, 28% and 36%. For an FHA loan, it's 31 and 43. And for a VA loan, it's 43 across the board. The one that you're really going to have to do anything with or know, and typically it'll say it on the test, is the conventional loan. Now let me explain what I mean when I say 28 and 36% ratios, folks. When we're looking at your income, first and foremost, we're looking at your gross monthly income. What does gross mean?
Before taxes.
Before taxes. I always like when somebody's squirrely and they're like, it means it's icky. I'm like, that's not the right type of gross. Stop it. Okay, that's not what we mean. Gross before expenses, before taxes, something like that. And so let's say that you make $6,000 a month in gross income. Okay, let me explain what these ratios are. The 28% ratio is stating that your monthly housing expense cannot exceed 28% of your gross monthly income. And so if you were to put this in a calculator, okay, your $6,000 in gross monthly income times 28% would mean that your total housing expense cannot exceed $1,680. And that includes your pity payment and potentially any monthly HOA dues. Everybody with me? The bank is stating that we will not let you borrow more than what would cost $1,680 a month in total housing expenses. Now, the 36% ratio, and understand, folks, they look at both. It's not one or the other. They look at both. Think of it this way. These are checks and balances for each other. So the 36% ratio says your total recurring obligations cannot exceed 36% of your gross monthly income. So yet again, you take your gross monthly income of $6,000, too many zeros, times 36%. And so what that's stating is that your total recurring obligations cannot exceed $2,160. Well, folks, if you've got a $300 a month car payment and you got a $150 a month credit card payment, you would have to subtract those out to see what you had left to go towards your housing expense for buying this house or applying for this loan. So $2,160 minus $300 minus $150 would be $1,710. So let me explain what I mean when I say these are checks and balances for each other. They will not break either rule for either ratio. So if they allowed you to have a housing expense of 1710, they broke the 28% rule because that exceeds that number, doesn't it? So based on this circumstance, you would only qualify if this was your financial situation for monthly housing expense of 1680. They are checks and balances for each other. Let me explain it a little bit more in depth so you can see why this is so important. Let me change one thing. Let's say that you had student loans of $400 a month. So let's go ahead and take that out. So now your recurring obligations, minus that 400, would mean that you would only have 1310 left for housing expense. Well, folks, if they gave you 1680, they broke this rule. So in this financial picture, you would only qualify for a monthly housing expense of 1310. Does this make sense? They're only going to give you the more restrictive of the two. And this is why you may have heard some people say, well, I had to pay off my car in order to buy my house. It's because paying off their car eliminated that monthly recurring debt, and it allowed them to hit the other debt to income ratio. That's why this works. But let me tell you one of the other big reasons why they always use both. Folks, imagine right now that you had no car payment, no student loans, no credit card debt. You have no recurring debts at all. Now, you've got the 28% and the 36% rule. But here's the question, folks. We already said that the average mortgage is for 30 years. What is the likelihood that you will not have a credit card payment, a car payment, child support, alimony, or any recurring debts for the next 30 years? Beverly says 0. Absolute nada. Probably a good bet. Sometime in the next 30 years, you're going to have all of that. So even if you have no recurring debts, they're still not going to let you qualify for this much. They're only going to give you this much because they cannot break either rule. Does that make sense? So let me show you what an actual math question looks like for this topic. And there's two styles of questions, as there always is. There is the standard way, and then there is the reverse engineered way that we always like to call it, where we're kind of looking at from a backwards point of view. So right here, I'm going to work through the first one with you, and then I'll have you practice the second one, and I'll do that with the other style of questions too, just to see how you're feeling. And as I said, this is slightly a more abstract style of math, so some of you are going to be fine with this, some of you are going to hate it. That's just the way it always goes. But here's an example, okay? Buyer's gross monthly income is $3,000. His recurring debts are $150 for a college loan and $250 for credit cards. What is the maximum pity payment this borrower can qualify for? Now, this is what we just did. So you would take their $3,000 in gross monthly income, multiply by the 28% rule, which is pretty straightforward. Under the 28% rule, they cannot qualify for more than $840 a month. Oops. $840 a month in total housing expense. And then you would take your $3,000 and multiply it by your 36%. And so under the 36% rule, what we're stating is total recurring obligations cannot exceed $1,080. Well, they already have recurring debts of $150 and $250. And so, let me make sure I'm not missing any. Of the $10,080 for the 36% rule, you'd have to take out the $150 and the $250, which would leave them with housing expense of $680 only. And so if they were to give them $840, they'd be breaking this rule. So how much pity payment can this person qualify for? The more restrictive number, only a housing expense of $680. That will be the answer. You have to work out both, because you will never know which one's the more restrictive until you work out both. And it is always the more restrictive. The banks will not break either of the rules. Does this make sense? So let me give you one to attempt. Now, folks, don't overcomplicate it. There's a few more steps in this one that I'm going to have you tackle. It is husband and wife borrowing together. They both have annual incomes. Do not overthink it. Add their annual incomes together and divide by 12 to get their combined monthly income, and then work it out the exact same way I just did. So take a look at this one, see what you come up with. Give you another couple moments, and then we'll work through it together. Stop it, Cheyenne. She's over there yawning. It's no, stop it. Still got 40 minutes left. Cut it out. I see all. So let's work through this. See how you're feeling. This is the same style of question that I just worked through with you, albeit, a couple more steps. So, man has an annual income of $38,000. Oops. His wife has an annual income of $35,000, which gives them combined annual income of $73,000, but this is based on monthly, so divide it by 12 to get their gross monthly income of $6,083.33. Now, really and truthfully, if you rounded it to keep it simplistic, it's really not going to make a difference in your answer. It'll never come down that close, but I'll just leave it at that for now. And so now we just apply the 28 and 36% rule. So gross monthly income, and I'm just going to put it as $6,083.33, poopy. $6,083.33 times your 28% rule. And so that says under the 28% rule, their total housing expense cannot exceed $1,703.33. And then under the 36% rule, take their gross monthly income again of $6,083.33, multiply by 36%, says that their total recurring housing expense cannot exceed $2,189.99. And actually, I'll just go ahead and put $2,190. Some of you rounded, some of you didn't. It will never come down to a dollar rounding, so we'll just say $2,190. But we're not done yet because they have already recurring obligations of $600 a month. Is there any others that are hidden over there? Or is it just a 600? 600 a month. So minus 600 means that they have left for housing expenses $1,589 or $1,590. If you round it, if you didn't, doesn't matter. And of course, if they were to give you that much, they broke this rule, so they're not going to do that. The only one you could qualify for is the $1,589.99 or $1,590, however you rounded. Whoop, whoop. So that is the answer. You have to work through both, but you're picking the more restrictive of the two. How we feeling? And be honest, because I can't help you if you don't tell me you're struggling. You struggling? Just struggling? Yeah? No? Yeah? You know, Anthony, normally I'm pretty good at reading lips, but you're too enthusiastic in the way that you talk. I got nothing. I don't, you're just like, there's a lot of enthusiasm. I know that. Okay, that's what I know. Brooke says his ASS is mathed out. Well, you're supposed to be using your brain, not your that, okay? Of course you can't come up with the answer if you're using that. You know?
I missed the monthly part. I got everything down, but the keyword monthly. And that's what messed me up. I kept wondering why I wasn't getting that answer.
There you go. It's based on monthly because they're making monthly payment, so they're saying what you qualify from a monthly mortgage payment point of view. Bree says the math is cool. Your brain is tired. Yeah, understandably so. I told y'all time and time again, I know this is torturous. Just remember one very important thing. Actually, I'll give you two very important things. You signed up for it. I didn't make you take it. Neener, neener, neener. Number two, yeah, that's cold-blooded. I know. Number two, it's means to an end. Because I told you I have friends that make $200,000, $400,000, $600,000, and $2 million a year. So 80 hours of pre-licensing, no matter how much you don't like it, could really be worth it to some of you. Just a thought, you know?